We've heard the president argue that the reason rates should come down also is because the economy is doing well and things like the housing market. Are you saying that you agree with the president on that front? And if that's the case, what's the risk that the long end continues to rise and doesn't solve the problem that rate cuts are supposed to address?
So it's a great question. So the first thing I would say, the housing market is stuck. Whether it's building permits, mortgage applications, new home sales, housing starts, we're at levels like in the 60s, similar to the 60s and 70s when the population is roughly double the size. Housing market is stuck. What does that mean? You create a dynamic in the economy where people, if you want job mobility in a tougher job market, it's harder to move because you can't sell your house, particularly if you have a 3% mortgage. We need to bring down housing costs. We need to bring down affordability of homes. By the way, I've argued this on this show many times. If through the funds rate mechanism, the mortgage rate comes down, I'll get to the other part of your question. If you bring the mortgage rate down, you'll actually build more homes in this country so home builders don't have to subsidize the mortgage. You actually bring down shelter inflation, which has been sticky. Your point is well taken. Listen, as an investor, we like the front of the belly of the yield curve because you have, like today, could you have a steepening of the curve? Listen, there's a series of tools that the Treasury can implement, a series of tools that the Fed can implement to be thoughtful about how do you manage further out the yield curve as opposed to just we move the funds rate in moderate increments. There's a lot of tools at play to try and contain where the back-end interest rates are.